When it comes to getting a small business loan, your credit score matters and matters a lot. Unless you've been in business for years and have shown consistent revenue growth over those years, lenders are going to want to look at your personal finances. That's why it's important to keep your credit score high. If your credit score has taken a hit or two, the good news, there's ways to fix it. I'm Donna Fuscaldo. I'm a senior finance writer at business.com. In this video, I am going to discuss what goes into a credit score and ways you could fix it with an eye towards getting a small business loan. Lenders use different means and criteria when determining your credit worthiness, but a popular one is the FICO score. This is what most lenders look at when underwriting small business loans. When it comes to the FICO score, it's made up of 5 components. Each are weighted differently. Your payment history accounts for 35%. This is important because lenders want to know that you're going to pay your bills. They look at your past to get an idea of your future. The amount of accounts you have open accounts for 30% of your credit score. If you're using a lot of credit, it's a red flag for lenders. They want to see that you have open accounts but aren't maxing them out. Your credit history length accounts for 15%. This is how long you've had credit. For people just starting out, it could be hard to build that credit up. Credit mix and new credit cards account for 10% each. They look at what types of credit you have and then how much of it you've opened recently. If you've opened a lot of credit cards in a short period of time, that could be a big red flag for lenders. A FICO score of 670 or above is considered good credit. If you're in the mid to upper 700s or above, you'll get the cheapest rate on a small business loan. Good news, there's easy ways to improve your credit score. It won't happen overnight, but if you diligently work at it, before you know it, you'll have a higher credit score. The number one step is to pay your bills on time and reduce any outstanding debt. 35% of your credit score is based on your payment history. If you are paying your bills on time consistently, month over month, your credit score will improve. It's also important to reduce your debt as much as possible. Lenders want to see that you will pay back your loans, and they also want to know you have the ability to do so. That's why it's important to reduce the debt outstanding. Keep in mind that you should never close those accounts once they are paid off. Again, lenders want to see you're responsible. By having accounts open and not maxing that out, it shows you are a responsible person, and thus your credit score will improve. It's also important to pore over your credit reports to spot any errors that could negatively impact your credit score. You're entitled to a free credit report from TransUnion, Equifax, and Experian every year. Make sure you get it and look for any errors. Finally, do not open new credit cards. Once you've paid down your debt, once you've started to consistently pay your bills each month and identified any errors, you don't want to run out and start charging up a storm and ruining your new credit score. If you consistently pay your bills, keep your debt at bay, make sure there's no errors, you will quickly see your credit score improve and you'll get a small business loan at a cheaper rate. I'm Donna Fuscaldo, and I hope this helped you. Thanks.